Hello YouTube, this is Stephen with On My Way to FIRE, a channel about early retirement and all things personal finance. And in today's video, I want to talk about covered call funds and how my progress is going. So it's now about the 6-month mark since I got involved in covered call ETF funds. And there's a whole series of companies that are doing these. You can look into this information. I'll put it in the notes here for the video. You can do your own research and see if this interests you. If you're already purchasing these funds and have some experience, I'd love to hear your comments and how it's going for you. The fund companies I'm familiar with are YieldMax, Granite Shares, Neos, Roundhill, and Defiance. And there might even be some other ones, but those are the ones I'm familiar with. Personally, I'm holding a few funds from YieldMax. Most of the ones that I have are from Roundhill, and then I have a few from Defiance. And so there's just all kinds of different ways that you can invest in these. And you're basically buying a single share into a fund that has what's called synthetic options calls, and they're paying you a dividend on a weekly basis. And so I started these in October, mainly on crypto-related holdings, Ethereum and Bitcoin. Then I expanded it into single companies, and then I bought a few index-related ones. I'm up to 10 that I have. And so overall, I'm up about 5.5%. Okay, and that's everything all in. And so my strategy is to buy these in a Roth IRA, buying single shares, sometimes 3 to 4 at a time, but for the most part 1 to 2. And it's with whatever cash I have available. So let's keep in mind, I'm under 50, so there's a limitation on how much cash I can put in my Roth IRA every year. So I am maxing my Roth IRA, but I am able to harvest gains on things that I bought from the previous years. And so in the last few months, the oil and gas stocks have all gone up quite a bit. And so I'm using that as my capital to get some of these started. So it's a combination of paycheck contributions, dividends from existing holdings, and proceeds from sales. And it's pretty amazing that my focus has been so strong on these funds for the last few months that I'd say I'm probably putting somewhere between 80 and 90% of new cash into these funds. And away we go. So since October, the holdings are $15,600, and the value is just over $800 in profit from that point. So my total return is just over 5%, and I'm opting to have the dividends reinvested. And what's happening is the dividends are compounding week after week, but based off the stock's performance, the dividend could be slightly higher or slightly less per share, but I'm continually adding shares. So even if I have a down week and I go from 15 to maybe 11 or $10 on dividend, maybe the next week, I'm buying another share or two. I have the purchase from the dividends of that week, and the next week I'll have more shares for the next dividend payment. And so since March, that's really where some of these started to take off. And I'd say the crypto-related ones are my losers. I'm negative 5 or 6% on the Bitcoin and Ethereum one. And then I have one for a single stock related to crypto that's down 20%. But part of that is related to the dividends reinvesting early on, purchased at a higher price. So I actually did a whole calculation on an Excel table to break down the actual purchased cost basis shares and exclude the dividend reinvestment, and then also break out the dividend reinvestment. So as far as dividends received, as of today was my first update for this, it just cleared $2,000. It's $2,001 in dividends for $15,000 purchase. But my net gain is only $850. So it's telling me that some of that dividend overpaid for the funds during the time, especially in those first few months, probably through January, when things were really starting to accelerate and go down. The good thing about it, though, is because I've been consistently reinvesting and just leaving it alone, the dividends just keep piling up week after week. And so some of the single stock funds, I'm going to earn between $80 and $100 a month. So the grand total of all dividends received is going to be about $540 to $560 per month. Okay, but it's broken down weekly, and if we divide that backwards, I might have I might have a week where I only make $110, and the next week after that I might make $150, might make $160. It all just depends on how some of these perform. But by me continually buying, that will help keep the dividend amounts somewhat stable. And pretty much when I go back to the history, what I'm seeing is the dividends kind of fluctuate a week or two. They become a little bit more steady if the price stabilizes, and then it will go up a bit if the stock rallies from there. It's generally a 1 to 2 week lag between a stock having a real strong rally. So some of the stocks that some of the covered call funds I have related to tech and NASDAQ, those took a bit, but now the dividends are really rolling in. And it's pretty amazing to see the progress and just the dividend compounding. And so on some of them, I stopped buying them for a bit, and I maybe only have $1,000 in one fund, but 19% of the shares that I have is because of the dividend reinvestment. And some of the ones that I buy more frequently, the dividends only comprise about 5%. So it really just depends on how often I'm buying, what the current share price is, and the compounding effect of how the dividends are being distributed. If it's a high distribution month and I don't buy a lot, that will definitely increase the percentage of shares that I own because I'm not purchasing as many on my own, if that makes sense. But my general outlook is between the 10 funds to try to buy somewhere between 2 and 5 shares a week of each fund. And it's not perfect. I don't have unlimited capital to get in. So there's some weeks where maybe I buy 7 or 8 shares of one fund and only 1 or 2 of the ones that I haven't put as much a priority on. And the overall goal is to get to about 3,500 in each holding. And that's whether that's from my own cost basis, or if, let's say, I put in 2,800 and it rallies and it gets to 3,500 based off all the dividends reinvesting, then I'm going to consider that 3,500 as well. So I'm going to consider it based off cost basis or value. Then I'm going to evaluate where it's going. And I'll probably give it about another month or two from that point and decide based off how much in dividends are coming in. Maybe I want to shut off the dividend reinvestment and just take it as cash. And now I can be more aggressive with buying and selling shares. And so right now it's pretty much only been accumulation. I have purchased some shares and sold them for a gain, but it hasn't been a lot, and I've maybe made about $15 or $20 on it, so I'm not counting it in this calculation. I'm only counting what I have currently. But it's pretty amazing in a short period of time, in 6 months, with a limitation of only $7,000 and $7,500 this year for the Roth IRA, which I haven't fully maxed yet. I think I'm at about $4,000 for the year, that I've been able to sell enough, use dividends, and use new contributions to get to $15,500 in these funds. And so I see a lot of criticism on them, that they just give you your own money back, it's highly taxable, and that's why I'm doing it in a Roth IRA, to get that protection from not having to pay any taxes on the gains. So one important thing to note is that Fidelity just came out with an update saying that they're going to start charging fees for these funds. And so I use Schwab, and they don't charge any fees. But apparently there's some sort of revenue sharing agreement between the fund families. And I think Roundhill and a couple of the other ones are involved in that. And so what they're saying is by June something, they're going to assess a fee up to $100 per transaction. So I'm going to put a link to that as well in the notes, and you can check that out if Fidelity is your provider. And I think from the notes that I read, it's not going to affect dividend reinvestment, only new purchases from that point onward. So that is a bit of a bummer. I'm hoping at the last minute they make an agreement to not charge people for buying these. It's a really cool new type of way to get dividend income, but I think a lot of people don't understand them. And my lesson that I learned from reading other people's mistakes on Reddit was they put $5,000, $10,000, $50,000 in some of these funds right off the bat last spring and last summer, and the prices were really high and they really came down. And you really got to use dollar cost averaging to work to your advantage. And then we had a sell-off between the fall all the way through the end of March. So a lot of people could have gotten a margin call if they were also borrowing money, which is also dangerous because now you're using borrowed money on a leverage investment to begin with. So you're leveraged on two sides. And so just a lot of it to me seemed like unnecessary risk taking. And they were kind of going for what you call these YOLO moonshots. You only live once. And they were really going for something that in the end probably bit them pretty bad. So my method has been more slow and steady, and just keep monitoring the share prices. And it's actually working out really well. I was a little discouraged, I'll be honest with you, between January and February, where the price just continually went down. But I just did whatever I could to just continue buying shares and not get discouraged, and just pump myself up, seeing those dividends hit every week. And then you go from seeing dividends of like $3 to $5 to $22 to $26. And that's per week. And it's just amazing to see it compound. And so once I get some of these funds to come back, I think the crypto ones really are the ones that are going to make me the most, because the prices are depressed so much. You just got to have faith in those, those assets that they're going to come back. And if you look at it, Bitcoin and Ethereum are both down quite a bit from the highs about 6 months to 10 months ago. So there's plenty of room to run. I don't have to be in a hurry with buying these shares. And I'm going to use time as my leverage in this. New money will keep rolling in from other investments. I'll have new paycheck contributions to contribute to the Roth IRA. And the compounding will just keep building month over month. And I want to see, based off the NAV erosion, which is the net asset value, how these hold up if we get any kind of sell-off, because that's going to be the real test. You're going to have the double-edged sword of the stock going down, which is going to affect the price of the covered call, and then the dividend is going to follow and start dropping within the next week or two. So right now we're in an up market. I would even consider this like a melt-up, where everybody's putting money in and racing to outdo, try to get in on this AI trade and everything related to tech. And it's just funny because the financial media was talking so bad about this stuff a couple months ago, and now it's all about euphoria. So I don't know if that's a good or bad sign, if this will last for a while longer, if this really is a bubble that will pop at some point. But a lot of it comes down to the earnings, and these companies are reporting record earnings, and a lot of these tech companies are laying off people, and that's causing the stock to go up even more. And so it's sad for the workers, but for the investors and for the companies themselves, they're going to make their companies leaner and have less, ongoing expense related to human resource. And I think that's probably the wave of the future. There's really no way around it. And they might hire back in small batches, but I think a lot of these companies are just going to do whatever they can to reduce headcount. And if you're an investor in these companies, you'll be rewarded. So my takeaway is be slow and steady. Watch these prices. And another thing, a bonus thing that came up just in this last couple of days, was I found something called a tracking error, where maybe an index is down for the day a little bit, maybe 1%. And so sometimes these covered call funds will go down 1.5% because they're leveraged. And I actually found that some of the covered call funds went down more than the amount that it's supposed to. And so that's called tracking error. And that's where it gets out of balance and the price is lower than it should be. And sometimes it lasts for 10 or 15 minutes, and I've even seen it last for more than an hour. So thankfully I had some cash available, and I was able to buy a couple shares on that little dip. I'd already bought a share or two earlier in the morning, but I was able to go back and buy a little bit more. So it's really one of those things. How much time do you want to invest in tracking this stuff? You could buy a couple shares in the morning and just be done with it, or you could really monitor it like I do. I'm trying to get the best prices for my stocks, so I'm always monitoring to see what's available, what can I sell, what can I buy, and keep in mind what dividend income is coming in the next few days from other things that I can use. So that's my takeaway. And I'll do another update on this next month, maybe about this time, right after the first week of June, and give you an update on what my dividend income and performance is at that time. But as of right now, 5.5%, just over $800 in profit based off of the gains. But I haven't really sold much. So we're just continuing to invest, and I want to see how this goes. If I can get them all up to the goal, that would be $35,000 invested in these funds. So I'm not quite halfway there, but we're making slow and steady progress. And I hope you'll come along and watch the journey, and we'll see you in the next video.